Great. Just a quick shout out to Steve. He's one of the smart guys in the space, so he's a bona fide professor and just really a great person to work with. So happy to be here. My name is Miko. I'm a managing partner with Gumi Cryptos Capital. We're on our second fund. We've also been investing since 2018. We invested our fund one kind of into that bear market in 2018, so we're definitely comfortable with deploying during this kind of bearishness. So we definitely are happy with our fund one results. I think about 8 unicorns out of that, and we're definitely excited to be deploying fresh capital out of our fund too. So we're broadly diversified across all blockchain related areas, and we like to go into the early stages if possible.
Fantastic. Awesome. Thanks, Steve and Miko, for that intro, and great to have you guys. Okay, so let's do some quick project intros. I'll keep it rapid fire. I'm just going to call project names, and then one of you guys unmutes and gives us a one-liner. Let's start with NFT Bull.
Hi, my name is Berke. I'm one of the co-founders of NFT Bull. At NFT Bull, we are building an institutional grade NFT data analytics and the NFT trading tools platform.
Awesome, thank you. Portrait.
Hi, my name is Ryan. Together with Gilliam, we build Portrait. At Portrait, we build tools to build tamper-proof and verifiable websites for the decentralized web. And we're looking to raise after demo day.
Fantastic. Dossier.
Hi, I'm Mir Saqib, co-founder and CEO of Dossier. And at Dossier, we're building a workflow automation with embedded smart contracts with the help of decentralized data governance and with our layer 2. And hopefully
awesome.
We're going.
Thank you. Holonym.
Hi, I'm Nanak from Holonym. We're building a bridge for Web 2 and real-life credentials on-chain using zero-knowledge proofs. And we're using this for use cases such as silver resistance, ZK, KYC, so to speak, and decentralized wallet recovery.
Awesome, thanks. Devo.
Hi, my name is Nick, one of the co-founder with my partner Peter and Yula here. So Devo is a DeFi option vault that offers a solution to harvest sustainable yield from digital asset structured products, target for treasury and asset management. And we're also building a first-of-a-kind smart option vaults and option aggregator.
Awesome, thanks. MetaWork.
Hi, I'm Saksham. I'm founder of MetaWork. We are building a teams and community SaaS in the space. So mostly our domain is DAOs. We are trying to bring LinkedIn Discord features into it and make it very interoperable in the blockchain.
Great. OK Contract.
Yeah, so I'm Henry from OK Contract, and we automate the front end for interacting for smart contracts using widgets. So I'm telling the secret right now, and basically, so from any EVM smart contract, we can generate standalone widgets which we can copy paste into any Web 2 existing website.
Awesome, fantastic. Hyper Login.
Hello, we are building currently a ZK DID, a single sign-on method to onboard the next billion Web3 users instantly and bring in 100% traffic to all your dApps. Thank you.
Great. I think there's two teams that we're missing. So one is MEV NFT and Open Sigil. So I think they're not on now, but if they come on later, we'll ask them to introduce themselves. Awesome. Thanks for the intro, guys. I think that's fantastic. I'm just going to go ahead and pin Steve, and then, sorry, let me just quickly find Miko here. There we go. And then let me also pin myself. Awesome, cool. So, okay, guys, so let's then now start into the discussion. And I think what's probably on everybody's minds, especially as a first-time founder in Web3, looking to start their fundraising journey at the end of the program, which is probably about 8 weeks away. is, obviously macro, well, a lot of conditions have changed, macro conditions, the crypto market, equities, etc. It seems like there's a lot of headwinds. A lot of different things have happened over the past, 6 to 9 months. So maybe if you guys can set the scene a bit in terms of, what does the current macro and let's say, kind of fundraising environment look like? What are some of the trends you're seeing? How have things changed?
I'm happy to start. I'd like to say that like good companies are good, right? Building is good, traction is good, right? One of the things that this does is it really separates the wheat from the chaff, so to speak. So I think that the boundary of product market fit, traction, this kind of stuff is more and more and more and more valuable, right? So I think in this kind of wintry climate, it's kind of not sufficient to just have like a really big swing for the fences, beautiful dream, with no evidence, right? So that to me, like, so a couple of things that I would advise is, I'm a big proponent of kind of accelerating into certainty, right? And so, if you don't have product market fit, like, you should definitely, if you can, kind of cut your cost structure, right? It's way, 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 way better to cut early than to cut late, right? Like, because if you cut late, you spent it all, so cut early, don't cut late, right? So, cut swiftly. Be very clear-eyed about whether you have traction or not, right? So like, whether you're pre-product market fit or not, so that's what I would say is real, because what I'm seeing on my side is, we're deploying more than we were during the bull. Like we're so we see great high conviction investors investing, in great high conviction founders, right? So none of that at all has changed. And for us, like during the height of the bullishness, we slowed down, and now in the bearishness, we sped up. So like for us, that's kind of what we're like. But I think the bar is higher, so I think that we definitely want to see some results. So I think it's super important to be clear-eyed about where you are. And I think the boundary between pre and post product market fit, pre and post traction is much, much stronger now, and it's much clearer.
Yeah, so I would plus one everything Miko said. I think those of us that have been around for a while know that actually, like, the bear markets are the best time to deploy in terms of returns, which is what our investors care about. And so, Miko, we've both been investing through the last bear market. I mean, he's also one of the very smart guys in the space. We have a mutual friend who introduced us, and he told me Miko is always 12 months ahead of everybody else, and you can sort of see around corners. And I think that's what venture investors are trying to do, right? Like we're not worried as much about what's happening right now. We're kind of worried about what can be built over 3 to 5 to 10 years. And so in that said, like, I would say, generally speaking, this is a much tougher environment for founders than it was, say, a year ago. And so I think, like, just to provide a little context on sort of like how this works in terms of like where all the funding comes from. So most of the funds, like Miko's fund and our fund, we raise from groups like pension funds and endowments and large family offices. That's sort of like where the money originates. And when we get into these cycles, so we're kind of in a tough macro cycle, both specific to crypto and kind of broadly, right? So like there's these inflation concerns, people are worried about sort of like a recession, then you've got all the crypto specific stuff, like really starting with the Terra meltdown, and then like the merge is creating some uncertainty. So there's all these levers of uncertainty. What happens is the sources of capital way up at the top, sort of like the pension funds, the family offices, they start to sort of like slow down their allocations to funds. The thing is that funds like ours only raise every couple of years, right? And so the good news for founders is there's still a lot of money out there in private markets that's ready to be deployed into private companies. but I would say the bar, as Miko said, is higher, right? So if you go way back to like when we were just starting, like 2017, people were raising on like just a white paper, like basically just an idea. And then I would say like over time, like people wanted to see more evidence, like people wanted to see something that was live, even if it was a prototype. And we're definitely, I would say like that has only increased now in the bear market, is like people want to see evidence of like, the thing you're building that I mean, investors are primarily concerned about two things, like can you bring this thing to market? And B, when it gets to market, will anyone care? Right? So like they want to see that you're building towards something that could be $1 billion business or protocol, because the way venture returns work is that it's usually a small number of projects that power a lot of the returns. And so typically when venture investors are deploying, it can't be something where they invest at 10 and they're hoping it goes to 20, right? Like they're investing at 10 or 20 and they're hoping it goes to several hundred or $1 billion. Like you have to kind of like invest in things that you believe could be very large, kind of like world-changing sorts of ideas. And so that's what we continue to look for. Like Miko, we're continuing to deploy. I would say like, I don't think we've slowed down at all. I'm just thinking about like the number of allocations we've made over the past few months, and it's probably on par with what we were doing last year. And so that said, it does feel like the environment is tougher in the sense that like valuations have come down, and we can dive into that in more detail later in the call.
Yeah, no, that's great. And I think a lot of insights, and there's a few that I want to ask a few follow-up questions. But I also want to mention that, I hopefully a lot of the founders that are with us tonight, hear, the good news, right? Like you said, a lot of the funds were raised actually, before all this deterioration, the conditions started. And there's a lot of dry powder that needs to be deployed. I know both of you started to touch a little bit on, the expectations from the investor perspective in terms of, what the founders, need to be doing or need to be, focusing on, right? And I think Steve, you also mentioned how not just back in the ICO days, but to some extent, if you look 12 months or 18 months back, people with a 10-page deck could raise at, some pretty crazy numbers without anything really to show for it. So I want to deep dive a bit more in terms of, what should founders expect, in a very practical basis, right? I think especially now, one of the benefits of, of these type of market conditions is that, a lot of the tourists leave and, things seem to slow down a little bit. A lot of the builders, put their heads down, start to build and really focus on actually, building and shipping, right? But at the same time, you're doing that, and then that, especially for those that are going through the accelerator, they know that demo day is coming up in 8 weeks, and it's a great opportunity to showcase to investors, this is what I'm building, this is what I'm solving for, and then they're going to start on having those one-on-one discussions. So what should founders really expect in these conditions, and especially maybe Miko, to your point around more scrutiny or kind of like longer times to actually make decisions on investments. What would you say to that?
I can jump in quickly first. I think, the point you made about investment, the actual investment process taking a little longer is important to understand. So like a year ago, kind of mid 2021, we would see deals, and then they would go from like starting their raise to oversubscribed in a week, and it was sort of crazy, right? Because as investors, we're deploying millions of dollars, and it's really hard to diligence a project in the span of a week. And so I would say these days, the investment process is definitely it's back to what I would consider normal, right? Which is like at least several weeks. So you should expect like more diligence. Like investors are going to want to like chat with people who might be able to comment on your ability to build, chat with people who might be part of your target market. Like, what we do is like often at the seed stage, and particularly at the pre-seed stage, there's not as much to diligence on the tech side, but what we can diligence are the people, right? And so that's one thing you should expect is like, as investors, like I want to get to know like the people that we're investing in, because in a sense, many of the pre-seed bets are bets on the team and really the concept more than anything else. And so I would say definitely expect that the length of time from starting your raise to closing it has stretched out a bit.
Yeah.
I just want to emphasize that this is, in some ways, this is better for everyone. So I did make the case for the ultra fast party round. So, but it's a little disingenuous, right? Which is basically if you get like 30 low conviction investors, right? What happens is that by blind and dumb luck, you kind of get in, you get like maybe 3 or 4 kind of all in high conviction investors who will like help you no matter what. And they've been given like embarrassingly small allocation, but they're just really good people, and so they'll help you. So like I'm kind of making the reverse case, right? But the real best case that's best for everyone really is that you get ultra high conviction investors and that you actually take the time to figure out who you're putting on your balance sheet, right? And call references, like entrepreneurs always feel like, oh, having more time is always advantageous to the investor and it's always disadvantageous to the entrepreneur. And I think it's quite the contrary, depending on how you use the time, right? Because if you use the time to investigate the people that you're planning to take money from, like, in a sense, like, you should look to see what they're like, and you should call references on them, and you should look at their portfolio. And maybe what you do is you start calling people on their portfolio that aren't the big success stories, and you kind of try to figure out if they were, helpful in rain or shine, right? So like, you should definitely figure out who is joining your cap table, because the other downside of the massive party round is that you may luckily catch the 3 or 4 like really, really helpful people, but you're gonna also catch people who are just a huge headache, right? And they might not even be the biggest checks. They're just going to be the person who's calling you every day, when you kind of least need it, right? Saying things that are super unhelpful and annoying and making you lose your hair or sleep. So like, I would say, check up on who you're working with, work with qualified folks, ideally people who have entrepreneurship experience, who founded and exited companies themselves, because those are the people who have nerves of steel, right? Like when a founder says to me like, oh, everything's going great, my immediate reaction is like, wow, like when did I lose this entrepreneur's trust? Like, how can I get back into their trust so that they can tell me that what's really hurting them, like what's keeping them up at night? Because there isn't an entrepreneur at an early stage where everything is fine. And if someone is delusionally thinking everything's fine, then they're not actually good entrepreneurs, right? I mean, I hope, if you're pre-product market fit, you think everything's fine, like you're the one with the problem, right? So like, so you want to find an entrepreneur who makes your problem into their problem, right? You want to find a investor who's like, how do we solve this? Like our boat is sinking, right? And it's like, it's our boat that's sinking. Like I'm in your boat with you. And like, if the boat sinks, right? And the thing that's funny is it's a mind trick. And the reason why I say it's a mind trick is if your boat sinks, they're not sunk. They're just like, okay, fine. Right. But
yeah,
you want the ones that can do that for you emotionally. You want the ones that can be like, I care about what happens to your boat. And what's going to happen is they're going to fret about it. They're going to lose sleep. And maybe sometime in the shower or the next day or in the morning, they're going to be like, I figured it out. Like, I know what you need to do. Or here's 6 people you need to contact. Or here's a giant list of possible customers, so like, and let me know, or whatever it is they can do for you. They can design your next pitch deck, like whatever it is. But like, and you got to also understand how many portfolio companies they have, right? So, I think that's a factor. So, but to me, if you give them your hardest problem and they work on it for like 2 days and they come up with a reasonable solution, then that's good. Like that's what you hope for. They don't show up at your office every day for, the amount of time you do, because they can't.
Yeah, no, I think that, go ahead, Steve.
Oh, no, carry on.
No, I wanted to deep dive on this a little bit more, and so maybe the question will start with Steve and then go back to Miko. But this is a great point, and I think what I tell the teams is that exactly like Miko said, don't rush into things, right? Take the time to learn, who's the investor, what's the value they can bring. And I know, Miko, you touched on a lot of fantastic points. I want to dive deeper, and from the point of view of the founder, if I was a founder, if I'm lucky enough to, be oversubscribed and I need to be choosy, right? And I need to say, okay, well, maybe not everybody will be able to make it. How should I think about choosing strategic investors? I mean, I think, Miko, what you said are some amazing things. But, if I'm thinking of like, what would be the various things that, I might say like, okay, this investor is bringing X, this investor is bringing Y, this investor is bringing Z. What would be some of those things that I'd be looking for?
I mean, I think to me, like, you're definitely building your team, right? And obviously there are certain team members that aren't kind of as day to day, like if you think about like I'm watching the new Lord of the Rings on Amazon, and I'm thinking about these characters, right? So if you think about like Gandalf as a character, like the dude doesn't travel with the group all the time, right? He goes off and does wizard things and then shows up whenever there's like a big demon about to kill everyone, right? So like that's fine, right? Because you can't count on your investors to be there all the time, right? So what but you also need to look at them and think about like, what kind of people do I need to round out my party? Right. So, what are the skills that are essential for us? Like, for example, one of the things that I've been increasingly focused on is kind of pitch deck building and pitching strategies, connecting people with up round participants, so like that kind of stuff I think is handy. I have other tricks up my sleeve, but the thing that's important to kind of evaluate is do what the investors are doing to you, which is, get on their LinkedIn and just look at their history and look at their behavior and just really scrutinize them as individuals and because you're interviewing them, right? So in a sense, you're like, well, what have they been doing? What did they do in their career? And like, what does that mean for what I get? What do I get, right? What is the experience base that I get? What's the expertise that I get? And then obviously, call references.
Yeah. And in terms of references, specifically are sort of like teams they've worked with, right? So if you can identify other teams they've worked with, just ask them like, has collab been helpful to you? And that's going to be a great source of information, right? Because like you're about to travel the road they've already traveled, so they can sort of like give you a little bit of a map in terms of what it's like to work with that investor. I think you can ask the investor themselves, like, what are the ways in which you typically work with companies? What sort of value do you add? And then you can ask if you have some investors that you've sort of decided on and are going to be participating, you can ask them for feedback. Like, it's actually a relatively small industry. We've all, in terms of like the active crypto funds, we've all co-invested together. We've all seen what sorts of value others add or don't add. And I would say like, there's kind of a spectrum, right? So like on one end is like investors that are actually like negative value, like value detract. And that's where maybe they're like, go out and like fund competitors right after they fund you, or they're sort of like bothering you with things that aren't important all the time, or like they're actually doing something that like has a negative impact on the company. Then there's like a lot of investors in the middle where they're sort of like value neutral because they write a check, but then they just kind of like go away and they don't really participate. They don't really add much value. They're not out sort of doing things that detract value. but you're sort of not getting a lot out of them. And to Miko's point, even good investors can become sort of value neutral if it's a really small check for them. So like, this is important, is like when you do a round and you've got sort of like 10 investors that have like very, very small checks, it might not just rise to the level of being super important to them. It's like, we usually don't like to see rounds that are just one investor. Like even when we lead, we typically will purposely not take the whole round because we want to bring in one or two other funds that we like working with. But also, like, I think where you get these party rounds where it's like 10 or 15 investors and everybody throws in a couple 100,000, like it's just not going to rise to the level of being super important. So you want them to have like an appropriate amount of skin in the game, like 2 or 3 or 4 funds are probably kind of like the sweet spot. And then there's the true value add investors where like Miko and I had a deal where like we jumped on the phone with the founder every other week, actually it was every week for a while, for maybe a year, because like we were just really invested in it. We really wanted them to succeed. And they did. They sort of grew, through launch, like eventually got a bunch of integrations and then raised a big up round with a new lead, at which point Miko and I can reduce our cadence down to maybe like monthly with the founder at that point, because there's sort of like a new group in the mix that's also adding value. So I'd say the best place to find where the investor falls on that spectrum is by talking to existing portfolio companies.
Oh, I think we lost you for a bit at the end. But anyway, I think you covered a lot of really useful and important things. I'm going to jump around a little bit, only because I just want to close the loop on this topic on one question that actually quite a few of the founders have been asking over the last few weeks, which is, what is the best way to turn down an investor? And it could be for many reasons, right? It could be because, look, they came in a bit late and you just can't squeeze them in. Potentially, you know, based on what you said, that if it's going to be really small, you feel like you won't become very important to them, or any other reason, right? You know, what's the best way to turn down an investor but not burn the bridge and potentially, you know, talk to them again at the next round?
I mean, I think to me, it's like any kind of like human relationships, right? In the sense that like you want to really try to be like a smart business person. And what I mean by that is that like you should definitely have a conversation, right? Like, for example, like we prefer to lead whenever we can. We lead more out of our fund too than we follow, right? And the thing that becomes really interesting is that like you know, like sometimes you don't actually know what you even have, right? So like, you know, if someone is just unilaterally like, we decided that, you know, we don't like you, goodbye, right? It's sort of like, you know, from our side, we look at that, you know, if someone that happens to every investor, right? And people have reasons, right? Share the reasons, right? And don't bring it at a stage where it's a fait accompli. Like, don't be like, we unilaterally decided this, right? Like, you just say like, look, this is what we're thinking. Like, we're thinking that this and this, you know, so that you give the other person a chance to respond, right? They may respond by being like, you know, if that's your concern, we'll do X, Y, and Z, right? We'll change the terms. We'll do, you know, so give the other person a chance to respond, because that's just smart. If the answer is still no after that, like what happens is the person who understands your reasons, you know, there will be times when the person just rejects the reasons, right? So it says, okay, I understand that those are your reasons. I think you're wrong, you know, but if that's what you think, go ahead, right? And that's still respect. There's still respect, right? Which is you gave, you know, I gave my shot, and like you were like, you know, we have another idea, right? But like, you know, if someone just is unilateral and they're like, oh, we decided this based on not talking to you, that's a bridge burned. Like I you know, it's sort of like, because what it means is, it means you're not a good enough entrepreneur to actually explore an opportunity that's in front of you. Like, you're not even exploring it. So it's sort of like, okay, if you're doing a customer deal, are you not exploring that opportunity? Because like, how is it that you're not talking to people that could affect the fate of your project, right? So to me, like, that's how you burn a bridge, right? You know, saying no to someone, it's like, yeah, I mean, we say no to lots of people, and then later maybe we say yes, or like, you know, same with lots of people. So, you know, there's nothing wrong with saying no to someone. You just have to give them a chance.
Yeah, I would agree with all of that again. So basically, I mean, like, we're all humans, right? It's just like having conversations, I think is critical. I would say the ones, just to Miko's point, the ones where like I feel badly walking out of the relationship is where a decision is made with no conversation, right? And the other thing is, I would say, in fact, the largest check we wrote out of Fund 2 was a deal that we had passed on in the prior round, right? So like, even when things don't work out in terms of an investment, and it could be on either side, either like for us, like we just wanted to see more evidence of product market fit. We wanted to, like, we had a bunch of things we wanted to see, kept talking with the team. They went out, they executed on those things. We got really excited about where they were at, and it ended up being the largest investment out of the fund. I'd say then one on the other side is where like we really wanted to do a deal. They ended up getting a bunch of term sheets. One came in at a valuation much higher than ours. We weren't comfortable at that valuation. So the deal didn't end up working out, but we maintained a good relationship with the founder. About 3 or 4 months later, that founder sent another deal to us because he had enjoyed sort of like the interaction. And that deal ended up being, as of today, one of the highest performing projects in our second fund. And so like, maintaining a good relationship is key, even when the investment doesn't pan out, because again, it's a small industry. Everyone's going to keep crossing paths with each other. So you want to do what you can to avoid burning bridges.
Yeah, no, that makes a lot of sense. And hopefully those are some very useful and actionable tips for some of the teams who've asked before. I want to take a step back and elevate the discussion a little bit. Obviously, we're biased, and a lot of the discussion so far has been very much about VC investment and VC fundraising, right? Which is not the only way that founders can raise. I think, I mean, especially Web3, you know, gives you so many other ways that you can do it. You can do, well, first of all, if you're going to talk to VCs, you can do equity, you can do SAFT, or you can do a token sale, you know, a public sale. You could do potentially NFTs. Now, of course, I think, you know, some of these may be more or less attractive, you know, depending on the market conditions. But, you know, we'd love to hear from you guys. One, you know, as founders, how should founders think about the various ways, or, you know, to raise money? And, you know, what are some pros and cons? And you know, particularly in these current conditions, you know, are some more attractive than others?
I'll let you start, Miko. I got a bunch of thoughts.
Yeah. Okay. My attitude is this, right? Which is that, you know, there is kind of this idea of smart money and this idea of kind of signal production, right? So, you know, the thing that I think happens is that the most successful projects that we've worked with, you know, kind of the YGGs or the, you know, OpenSeas or these kind of like unicorn scale founders, you know, a lot of them actually have this kind of proper cardinality, right? So in a sense, like, you know, if you look at both of those, by the way, were kind of like GCC and then like, you know, A16Z. And I think that like the idea, you know, and then public, or, you know, OpenSea isn't public yet, but like they're definitely taking in a lot of secondary and a lot of like different, you know, styles of investors, right? So to me, like, I think that, you know, one of the things that can happen is if you do like crowdfunding, or if you do like public sale, or if you do, you know, if you kind of do the wrong sequencing, then like in a sense what happens is that if there's sort of an attitude of, well, you got, you know, C tier money because you couldn't get B tier money, and you obviously couldn't get A tier money, right? So like, so I do think that that's a relevant thing to contemplate as you build, right? Because, if you get kind of A-tier money, like you can continue to raise and you could continue to kind of grow the pie and but I would say that, like, there are situations where you just want to sell to the public, and that can be a tactical thing. But, I think that in large part, I think it is important to kind of use diligence proxies, right? So it's sort of like, oh, well, what does it mean that investor X, put in, invested in you, right? That's a signal of conviction and confidence, and it's their diligence is a proxy for the diligence of others.
Yeah, I would say there definitely is there's a signaling effect to some degree. I think, when we invest pre-seed or seed, then usually there isn't any sort of like predecessor investors other than maybe a small angel round or something. But when you get into later rounds, A rounds, B rounds, those investors, I think, are to some degree sensitive to, who is invested prior. I think in terms of structure, Stefano, you mentioned kind of like SAF versus token versus whatever. The vast majority of the investments we do are a safe plus a token warrant. That seems to be kind of like the dominant model right now. The way we got there is, for those of you that remember sort of like the early days of Ripple, Ripple was an equity deal and there were a bunch of equity investors, and then Ripple, of course, launched a token, XRP, and the investors had no access to the XRP token, which ended up accruing, as we know, a substantial amount of value. And so ever since then, investors sort of want exposure to both sides, both the equity side and a warrant, so that if a token network manifests, they have some exposure there as well. So typically, because, I think it's like nobody knows exactly where the value is going to accrue. So if you're putting money into a project, you want to make sure you have the instrument where the value accrues. I would say rushing a token out the door is not a good idea. This is, at least in our opinion. We've had to pass on deals where it's like, oh, we kind of like the team, like we think they're competent, we think they're working on an important problem, but they rushed this token out the door like 12 months ago. The token's now suffering. The token's got all these issues. It's going to be so much work to like rework this token network. There's sort of like the original sin, like once it's out there, it becomes very difficult to kind of migrate it, that it can actually become a drag. So I know doing a token sale is like, it looks like sometimes the quickest path to capital. But I would say, like, if one gets rushed out the door before there's product market fit, like if the parameters of the network aren't thought out, like it can be sort of a drag on the project in the longer run. I think doing an NFT sale is like a new interesting, something that we've really seen more of over the past, say, 12 to 18 months. Again, like, what does the NFT do? NFT is just a wrapper, right? It's just a programmable digital object. So what the NFT does is important, but we've seen, like the proof ecosystem basically got funded off the original proof collective card, like G Money's Admit One was a funding mechanism. He didn't really take VC capital. So there are models out there to fund via NFTs. I would say one thing we're struggling with, and a lot of investors struggling with at this point, is like, how does the NFT issuance work into the safe plus token warrant model? So normally, like, you do a safe plus a token warrant, you get equity, and then you also get a percentage of the network. Well, what happens if instead of issuing an ERC20, the project basically issues a large number of NFTs? Like, does the investor get a portion of those? And like, those, I think, are open questions. So that's something that a lot of people are thinking about right now. But yeah, maybe I'll pause there to see if there's questions.
Cool. I will ask one last question to close, just so that we have enough time for questions from the audience. But I know this is a question that is on a lot of the founders' mind, right? Which is around valuation. And I think, the question is really like, how should the founders think about valuation? I think that, most of us now in Web3 realize that the way that it's been done, for the most part, is not really the traditional way, right? You don't do a DCF model and try to come up with a number. But if you don't have that, right, and even if you did do that, but you didn't have the data to plug in, right, how should founders think about it, right? Especially the founders here today who are going to be going to demo day in 8 weeks. That's going to be typically the launch of their next fundraising round, and of course they'll need to say like, well, the number is this, and it's based on something.
Yeah, so I'm a big fan of like, let the market decide, let the lead decide, right? And so, so really like, don't get too hell-bent around valuation, kind of from the perspective of like calculating your optimal valuation. Like the optimal valuation will calculate itself if you focus on the right things, right? So the right things you should focus on are maximize the value in your project, then maximize the way you're describing your project so that you can get the value that you've built, right? And then run an excellent process so that you have the most possible bidders for that value, and ideally you get a multi-bid, which kind of helps to drive the value, right? But like, don't spend much time thinking about like, I would say the bottom line is this, right? Which is that the value represents the fair market calculation of the estimation of the risk, right? So in a sense, like, you should always try to me, like, and the risk is measured both by the entrepreneur and by investors, right? So the entrepreneur measures risk in the following way, which is sort of like, if an entrepreneur is super confident, then they're just going to raise a small amount, which they're super confident that they're going to be able to use to create a gigantic effect, right? So so that allows an entrepreneur with incredible conviction to dilute very little if they're absolutely correct, right? Now, obviously, if they have super high conviction and they're wrong, that's a different story. But like, to me, like, that's probably the best way to reason about valuation, which is really focus on, number one, building the actual value in the project, and then number two, focus on running as excellent of a process as you can to get the value you've built recognized by the market, right? Because I think that any other methodology will probably just churn your time.
Yeah, a piece of advice that one of our VC investors gave me when I was a founder about a decade ago was, he said, look at every round as the most expensive money you're ever going to raise. Because if the project keeps executing, typically the valuation continues to step up through rounds, which means that every dollar you raise today, you're giving up a larger piece of your company relative to like every dollar you're going to raise 6 months from now, or 12 months from now, or 24 months from now. I would say we've seen projects taking a little more dilution. So maybe they would have raised 2 on 20. It's kind of the height of the bull market, and now they're raising sort of 2 on 10, right? So I would say valuations have come down, but I also agree with Miko that it's not your job to basically set the valuation. I mean, that's the investor's job. I'd also say that, you don't need to overraise. Like, don't raise 2.5 if you can get to where you need to be with 1.5, something like that, right? So I would say, yeah, I think, the other thing is, like, it's very tempting right when you close the raise to go on a hiring spree. And, to Miko's point, be very slow to hire and sort of fast to fire. We invested in a company a couple of years ago. We're very excited about the direction they did a round. There were some great investors in the round. They got about 4 or 5 months in, and they had been working their tails off, and they just realized, like, this isn't going to work. Like, it's not going to work for X, Y, and Z reason. The founder was really decisive, like basically laid off the entire enterprise sales staff, like cut back, still had like 20 months of runway, completely pivoted the company, and then ended up being successful. Like, found a new direction, I think 6 or 8 months later, was able to raise a new round and get additional capital. And so, as a founder, it's your job to get the right people on the bus, kind of point the bus in which direction it's going and put gas in the bus. So getting the right people on the bus is really important. So I would say, if you do have a choice of various investors, it's less about valuation and more about which are the investors that are going to help me kind of get to the next milestone where we put more gas in the bus. And so that's often what we're counseling founders is like, bring in the investors that you think are going to be the most helpful, not the ones that are necessarily going to put the highest valuation on the project today.
That's some amazing words of advice. So I think with that, let me go ahead and remove the pins, and I want to open it to to the audience for questions. I think we have about 10 minutes or a little bit under that, so probably time for 2-3 questions max. So for all the founders out there, if you guys have questions, just unmute and speak up. Mir, go ahead.
Okay, thank you so much. So I have 2 questions, but I will combine it in one. So the thing is, like, while you're fundraising and doing the product building as well, so will it be dynamic fundraising? Because there are some times when pivoting comes, and there are some features that you never thought of, and also with the traction. Let's say I'm thinking of growth of 5x, but having a 10x growth. So at that time, there's a capital need as well. So will we always be, or having the fundraising going on, like on the side? And another one is like in the pre-seed stage, like the product that we're building and that is live right now with the users, and we have some traction. And also we have some vision as well. So what actually brings that attention from the VCs, like what they're actually looking for? Because sometimes the traction is not sexy enough, but you are talking about teams, but what kind of executions are you talking about? Is it the product or how we're executing the whole roadmap that we have promised or that we're working on and giving to the community?
So I want to address your first question, right? Which is, how often should you be raising, right? And so I have a philosophy where I call it Periscope up, but not Submarine up, right? And what I mean is that, like, you kind of almost always want your Periscope up, right? So to me, there's this amazing thing, which is in VC, the adage is ask for advice, get money, right? Ask for money, get advice, right? So this adage is very wise in the sense that one of the things that's helpful is actually kind of casual conversations with VC buddies. Now, here's the funny part. The funny part is that, like, most VCs are inundated with requests to be buddies. So like it's kind of hard to pull off, but like if you're sufficiently impressive, then VCs will invest time in you when you're not raising, right? And to me, what's the value of that, right? The value of it is because here's the thing. The reason why I say Periscope up is that you do want the ability to check the temperature of the market according to several VCs that you trust, right? Because, the temperature of the market, because the thing you don't want to do is you don't want to be like, okay, we're about to run out of cash, let's raise, right? Like that's kind of bad, right? So you'd rather know what's going on up there in their weird VC heads, right? So you want to be able to kind of constantly have some way of casually knowing what's going on, right? Because the official declaration of I've started raising is kind of something that you want to do once you're pretty sure that you already have ready money. Right. So that becomes this sort of formal, like, then that's when the entire submarine comes up, and you're like, okay, we're, now we're raising, right? But like you do it when you're sure that that's going to work.
Thank you.
I think just very quickly, you were asking kind of like, what do investors want to see? Do they want to see like evidence of usage? Do they want to see you did what you said you were going to do? I think the other thing they want to see, which I mentioned earlier, but I would just reemphasize here, is like they want to see you're building towards something that looks like $1 billion project, right? Like they want to know you're building towards a very large total addressable market. And so I think that's sometimes a piece that founders can, I mean, we did it ourselves. Like I remember at my software startup, we found an investor, they wanted to lead, and they said, you need to be thinking in terms of billions, not millions. And I always remember them saying that, because I was like, what do you mean? Like, here's the thing we're building. They're like, no, like expand scope. Like think about how big could this be if it really, really works? And so I think it's important, like, to just really understand that venture investors need to believe that there is a very large outcome if you are able to execute on the vision. And then what they're trying to assess is how likely is it that this team executes on this vision. So I would say, in addition to the traction and all the other things, like making sure you understand, like, what is the end state look like, and is the end state sort of like sufficiently large to justify venture investment.
Thank you so much.
Who's next? I think Henry, you had your hand up, or we
it's
can go to
Dijar.
Saksham.
Sorry, can you hear me?
Yeah.
Yeah. Okay. So I have a quick question, also following up on Mir's question. So, how much time would you recommend to spend on a seed round? Like, what's the optimum? Because we are constantly contacted by someone, but how should we organize?
Yeah, so I kind of want to continue with the submarine metaphor, right? Which is that you definitely want, like, there's a difference, like, to me, like, looking, a periscope is just looking, right? So you're just looking, right? So the question is, how much energy are you spending, right? So to me, like, the just looking amount of energy is maybe on the order of like 3 hours a week. And, you know, if you want like that kind of level of investment, you know, ideally you've chopped it into things like 30-minute or even as low as 15-minute, like different chunks, so that you're getting a spread of opinions in a fairly short amount of investment, right? But when the submarine goes up, it's basically one person, typically, like, you know, the founder, basically goes full time, right? And once the submarine's up, like, ideally you want to spend as little time in that configuration as possible, because that's when you're doing that, you're not actually building products, you're not actually talking to customers, you're not actually doing, you know, the more important part of your job, right? So I would say that those two modes are very, very different, right? The kind of submarine, the periscope mode and the submarine mode, right? So, you know, what you want to do is you want to use the periscope to tell you when to bring the submarine up, right? And you want to be clear what you're doing, right? You want to be like, right now we're in periscope mode. And by the way, like, that's a great thing to say to an investor. A great thing to say to an investor is, we're not raising right now.
Okay,
like,
so
that's
basically
good. That's a good thing to say.
Yeah.
It makes them
So
even
they
more
contact
interested.
you and you say, I'm not raising, so I will reach out to you like when I will be raising.
Yeah. Put them on a list. Like, put them on a list. And you know, it's smart to feed them updates. And updates, you can do updates. You know, if you're kind of thinking about raising, like, put them on like weekly or bi-weekly updates, and just give them like updates on like how amazing traction you're getting, or all the, you know, the whatever progress you're making. Just, you know, and obviously you can ask them, like, you know, do you want to get our updates, right? Because if they're inquiring, they should be on a list, and you should be updating them. That's kind of the cheapest way for you to, like, you know, because you have a spreadsheet, and you can just like, you can use like Google Mail, and you can just have an updates template, and you can just like bop you know, rewrite the template every week or bi-weekly, and just bop out the thing to all of the ones on your list. Ideally, it's not like such a big list. They have to use like MailChimp or something.
Yeah, I know we're almost out of time, but I think there is a big pre-marketing period before the official raise, like the Periscope period, to use Miko's analogy, where you're saying, like, we're not raising, but we're starting to think about what a raise would look like. And you can kind of have like very substantive discussions that really get to a lot of the things you would need to know if you were officially raising, like what sort of range of valuations might investors be looking at? Like, what is this investor interested or not? Like, basically like you're starting to kind of raise, but you're not officially raising. Because to Miko's point, like once you start raising, you kind of want to have a group of interested investors like ready to go so that you spend as little time as possible. Because like there's the putting the round together, if it gets oversubscribed, there's all this allocation math, then there's the docs. Like it does require a bunch of effort for probably like a minimum of like a month, like including docs and everything like that. And it can be distracting. So you don't want to stay in that sort of configuration, as Miko said, for months on end.
Makes sense. I know we're out of time. And I know that Miko is answering some of the questions on the chat. And I think they're somewhat related. I think I'll try to synthesize it into one. So one is, when does it make sense to hold off from raising? And maybe when you are and when you're ready, is how do you create that understanding of how much you want to raise and what it's for?
I would say holding off. I mean, it's not always an option, right? Like you can only bootstrap for so long. That said, I would say if you're not getting interest, I mean, one could be you've articulated valuation expectations that the market thinks are too high. You've articulated a raise size that the market thinks are too high. Or there's something about sort of like the vision you're pitching that maybe isn't big enough or compelling for whatever reason to the market. So it's maybe not necessarily about holding off, but about like reconfiguring the story you're telling, the amount of capital you're asking for, like where you think you might, like generally speaking, if you're targeting a big enough market and you're a strong team, like you'll be able to raise somewhere. But like maybe you've been thinking it's at 20 million and in fact it's at 10, or maybe you thought it was at 15 and in fact it's at 8. So I mean, I just remember as a founder, like there was a moment where I was like, we cannot bootstrap any longer. We need to take investment at this point, even though it's like not at the ideal valuation. I mean, I know this was like a decade ago, but for context, our first raise was at 3, right? So you don't see $3 million rounds very often these days, but we just needed some money in the bank to kind of like some gas in the bus, so to speak, to get going.
Awesome. Fantastic. Great. We're just 2 minutes over time. So I want to thank Steve and Miko again for, spending your early morning in the West Coast with us. Thank you so much for all the insights. I think it was a fantastic discussion. And also thank you to the audience. I think we also had some great questions coming into the session, some great questions that we asked at the end. So yeah, hopefully everybody walks away from the session, feeling much more informed and with some very key insights for what'll come after 8 weeks after demo day. So thanks to all of you and have a great day, afternoon, and evening.